Hi, everybody. This is Doug Cha, the Executive Director at the Governance Center here at the Conference Board, and want to welcome you today to the next in our series of book discussions with authors writing about corporate governance. Today, I'm pleased to be joined by author and small cap financial expert Adam Epstein, founder at Third Creek Advisors LLC, based in California. Today, we'll be talking about Adam's book called The Perfect Corporate Board, Handbook for Mastering the Unique Challenges of Small Cap Companies. And this book was ranked the #1 bestseller in the corporate governance vertical on Amazon.com about a year ago. So we're looking forward to hearing about Adam's work, the particularities of small cap governance, and what large cap boards can learn from small cap companies' best practices. So before we begin, just a couple housekeeping items. We're offering Cpe credit for participating in today's live program. To get these credits, you'll need to stay online for the entire webcast. Enter your full name, email address, then specify CPE in the request Cpe credit space at the bottom of your screen. Also, there'll be 3 pop-up messages during the course of the program, and please click OK each time you see one of those. A couple other things. We welcome audience participation today. There is a box at the bottom of your screen where you can enter questions. I will see the questions and work them into the discussion. You can enlarge the picture to full screen by clicking on the 4 arrows in the upper right-hand corner of your screen. Please do complete the evaluation at the end so we can incorporate your feedback into future webcasts and get suggestions of what you'd like to see. And we will be posting a replay of this webcast for you and your colleagues to share afterwards. Without further ado, let's get started. Just a little bit about Adam. Adam's a nationally recognized expert in small cap companies and governance. His firm Third Creek Advisors advises CEOs and boards of pre-IPO small cap companies. In Adam's work, he's advised, governed, and invested in hundreds of small cap companies in the United States, and often is featured in publications such as the Wall Street Journal, Bloomberg Businessweek, Forbes, CNN Presents, among others. And prior to this, his role at Third Creek, Adam was a principal at Enable Capital Management before he held senior operating roles at MailEncrypt.com and Tickets.com, and before that he was a corporate attorney. So Adam, thank you very much for joining us. It's great to have you here in person from California. I've explained a little bit about your bio, so why don't you give us a little bit more about your background and the kind of work you do?
Sure. Well, first, thanks for having me. Honored to be here. I started out my career in much the same way you did as a kid at a large law firm, and after that had about an 8-year stint in senior management roles in pretty small, diminutive but fast-growing companies, and like lots of entrepreneurs, some moderate successes and lots of failures. And I'll throw my hat in with those people who believe you learn a lot more from failure than you do from successes. I have some scars from it, but like every entrepreneur, you kind of keep going. And and as you referred to in 2003, I co-founded a special situation hedge fund called Enable Capital Management with two other folks in San Francisco, and we grew that fund pretty dramatically over the course of many years. And what we did was very similar in a lot of ways to venture capital, except we were in the public market. So we invested in more than 500 small cap financing, so providing growth capital to biotech companies, medical device companies, all kind of different technology companies, energy companies, et cetera. And so that stint as an institutional investor was pretty formative in seeing decision-making that went on in a lot of small cap boardrooms that was not terribly artful, was fairly value destructive. Saw that over and over again. And subsequent to my buy-side tenure, I started spending time talking to former portfolio companies, trying to understand, what's going on in these small cap boardrooms? These seem like really smart people who are working hard. Why is the decision-making unfortunately, oftentimes, particularly with respect to capital markets and corporate finance, really value destructive to institutional investors, and that gave way to not only writing a book, but speaking about it, 150 times all over the world, where anyone would listen, frankly, talk about these small cap issues, and because it's something I'm passionate about and something that's pretty important for the economy as well.
So then, when did you decide to write this book? What prompted you to do that?
What really prompted me was subsequent to my buy-side tenure. I went to a corporate governance conference, and I really felt throughout the lion's share of the program that I was in the wrong room, frankly. I mean, I listened over and over again to these people, very sharp, well-known people talking about quote-unquote key material governance issues. And frankly, the ones that I saw in the small cap realm, all these companies focused on, none of those things were on the menu. And I remember at lunch at one of the settings I asked, when are people going to start talking about the things that are really material enterprise risks and material issues for the majority of public companies in the United States? And people looked at me like almost as if to say, I think you actually are in the wrong room. I don't know what you're talking about. And so there was a real disconnect. And I thought when I spent a lot of time talking to former portfolio companies, CEOs, CFOs, board members, asking them, hey, take me through how you went about deciding this issue, that issue, I realized that the resources were not available to companies like that. If you're a $100 million life science company and you need to go raise $50 million, or you have a situation where you need to retain your stock listing and you might need to do a reverse stock split to maintain NASDAQ, all those issues that are in some respects quite unique to those small cap companies, where do you go for information? Some of them ask me, well, Adam, where do you think we should go to get answers to that, right? We talk to our lawyers, but they're not capital markets or corporate finance experts. We can talk to our investor relations friends. We can talk to investment bankers. But number one, there's conflicts of interest in that ecosystem. And also some of those people aren't really experts. So where do we go? And it wasn't long after that I thought, there really is an educative issue here. And I reached out to a couple of different publishers and said, there isn't a single book on the subject, is there? And they said, no. And so that's what gave rise to it.
Yeah. I mean, I've been at these conferences, I've been speaking at these conferences, and we hear so much of the material to the mega cap companies. Yep. And the kind of intricacies of Rule 14A8. And the fact is, look, most companies don't get shareholder proposals, and so why are we, yep. Why are we wasting their time? Let's talk about something they actually need yep. to know. So, as you were writing this book, I'm sure you started with something in mind. And then as you were writing it, what surprised you about how the book was taking shape?
What surprised me the most? I tell people when I speak in various different venues around the world that in some respects, institutional investors are really forensic observers. We're paid to invest other people's money and observe everything from management teams to the board to everything about the company. There's a continuum of information about public companies. And as an institutional investor, you're paid to see and witness and observe everything, hopefully a little bit more articulately than others. And as a result, I had a stack this high of notebooks from all of my experiences. And I think what was the most interesting is after sitting through well more than 1,000 meetings with CEOs over the course of many years, I actually forgot some of these anecdotes of meetings. And for example, have you ever written a book?
Not yet.
Okay, not yet. So it is true that you find yourself at literally 3 o'clock in the morning, kind of with the light bulb, typing, trying to figure out what you're going to say. And in some of those moments, it was really comic relief to read these anecdotes from all these meetings. And one of them in particular, I had a meeting with a life science CEO. It was just this woman and myself in a room. And she set up her computer, was getting ready to go through her PowerPoint presentation. I looked up, I asked her a couple of questions. As she was answering, I looked down and I wrote the answer, and I looked back up and she was fast asleep. And I completely forgot about that until I read some of those things. And I thought, and apparently she had just flown in from Taiwan or somewhere else, but she fell asleep. We were the only 2 people in the room, and she was looking for $20 million, and she fell asleep. And the only record that I have afterwards on the piece of paper was, we did not provide financing to this company. But all those anecdotes just came kind of flooding back and trying to recollect all the different anecdotes and all different experiences of being an institutional investor, and that was really really interesting to relive all that while writing the book.
Sure. Well, good for you for memorializing all of that so you could use it later on. So let's talk about small cap companies and the importance of their governance. In the marketplace, CNBC, everywhere, everyone talks about the S&P 500, Fortune 500, but there are more. There are probably 100 times more, or at least 10 times more companies than the Fortune 500. Why don't you give us a little bit about the landscape of what small cap means? Well, I mean, why don't you first start with what does small cap mean in your mind?
Sure.
And then talk about the kind of the landscape of small cap companies in the United States.
So capital markets people tend to use the following nomenclature, and it's always based on market capitalization. And for some of the people that are listening that don't know what market capitalization means, market capitalization is basically your issued and outstanding shares multiplied by your stock price. And so institutional investors on the buy side folks as well as sell side folks tend to think about the world in terms of market capitalization. And if you have a $0 to $50 million, $50 million market capitalization, that's referred to somewhat pejoratively as a nano cap company. I didn't make that up, by the way. And from $50 to $300 million is a micro cap company. From $300 million market cap to $2 billion is a small cap. And then $2 billion to $10 billion is mid cap, large cap, everything above, mega cap, even higher. So a lot of people use small cap almost as a term of art, but to be precise, it really is companies between 300 million and 2 billion. For purposes of the conversation, one of the reasons why I use the term small cap to mean companies with market caps below $500 million in my discussions, I'm always careful to delineate which companies I'm talking about. But the reason is because, to your point, if all you did was read the Wall Street Journal or watch CNBC or Bloomberg, you wouldn't know that 80% of public companies have market caps below $500 million. That's why, to me, that's really the space that I focus on, because that's where 80%, it's just math, right? That's where 80% of public companies are. Now, in fairness, and to your point, most people look at just the exchanges, i.e. NASDAQ, NYSE, and there's whatever the number is, 4,000 some odd companies listed on there, and think, well, that's the universe of public companies. That's not true at all. There's actually close to 15,000 public companies in the United States when you take into consideration OTCQX, OTCQB, OTCBB, pink sheets. Reasonable people differ as to whether some of those companies should be public companies, but they are, and there's a lot of them. And so, to be sure, that number influences the fact that 80% of public companies are below 500 million. But when you look at just NASDAQ, for example, 45% of NASDAQ companies have market caps below $300 million. Okay, so half of NASDAQ companies aren't even large enough to be considered small cap. And when's the last time you read about that, right, in the Wall Street Journal and Bloomberg? So, look, the overwhelming majority of public companies are small, and you don't have to be a statistician to make the corollary leap, which is the overwhelming majority of directors govern small public companies. And so, again, getting back to that disconnect, that's a pretty stark disconnect when you realize that the numbers are that slanted in favor of small public companies, yet 100% of the dialogue in the corporate governance world is about, let's say, 500 to 1,000 companies.
And so why is that?
Yeah, I think there's a number of reasons, and I'm sure you have your own view about it as well. My perception is a couplefold. First of all, that's where the money is. So the large service providers in the United States, a lot of thought leadership comes from the big four accounting firms, for example. They're focused on the largest companies. That's where the dollars are. Same thing, ditto for the large law firms. They are focused on where the money is. But I think it's also worth being mindful that in all of our 401k programs, for example, that's where everyone's money is invested, right? Whether it's a pension fund, whether it's your own 401k, whether it's your parents or your children, whoever it is, that's where a lot of your 401k resources are. So there's a lot of focus on them because they are the largest companies. But look, you cannot. It is inescapable that an inordinate amount of job growth and innovation emanates from that small cap ecosystem. And so it's always a fair question. Well, why do we even care about the small cap? When you get beyond the fact that it's 80% of public companies, from an economic standpoint, the United States, it's incredibly important.
And so, you're an expert in, kind of showing people in terms of small cap companies how corporate governance is somewhat different in terms of how it's done. In the book, you have a term for this called entrepreneurial governance.
Yeah.
And so explain that a little bit in terms of how different that is from kind of the governance that the rest of us focus on at the GEs and Exxon Mobils of the world.
Yeah, so first of all, the term entrepreneurial governance, I quote unquote stole with a smile from Peter Gleason and Judy Warner at NACD. They're the ones who actually came up with the term after lots of different conversations about, hey, governing these smaller companies is fundamentally different. But I'll just give you an example of one of the differences between governing. When I first went to one of these governance conferences, and I mentioned at this lunch, there was a woman there who she said, I'm interested in actually the question you asked. Why would you ask, when are you going to talk about all these issues that smaller companies are focused on? She said, what would be an example of that? And I said, well, an example of that is trading volume. And she said, trading volume? She said, trading volume is not a boardroom or an enterprise risk. And I said, well, and then she actually set forth to kind of lecture me or browbeat me into the fact that clearly you don't understand the difference between management issues and government issues and governance issues, pardon me. And but the reality is that she's right in that trading volume is definitely not an issue for IBM or anyone in the Fortune 1000, where companies trade either dozens or hundreds of millions of dollars a day. But for the vast majority of public companies that need to serially access the equity capital markets, which is a truism, trading volume is determinative of how much money you're going to get and what those terms are. So a larger enterprise risk literally doesn't exist for literally thousands of public companies in the United States. So risk is relative, right? And I remember saying to this woman to try and make the point, a ski jumper who jumps off a 90-meter ski hill, to them, that's not risky at all. The drive to the ski hill is probably the riskiest part, right? For someone like us, it's horrifyingly risky to consider jumping off, but it's the same thing, right? For a company that has a really diminutive balance sheet and no cash flow, there's a lot of things that are going to qualify as enterprise risks that would never even make it on the menu of items to talk about at a large cap company, right? So really different table setting, and you have to, the entrepreneurial governance term came from, hey, you know what, we're focused more on surviving than we are thriving. And so surviving kind of connotes that entrepreneurial nature. You got to do whatever you have to get 1 quarter from now, 2 quarters from now, as opposed to strategically planning for something 5 years from now.
Got it. In the book, you also talk about, this, it's kind of often repeated, one size fits all, does not really apply here. So kind of from your point of view, how do you see this term of, one size fits all?
So it's really, it's poignant in that historically in the United States, when people have talked about corporate governance, it's not only how it's been taught, but also conceived that governing a big company is the same as governing a small company. As we talked about, when you attend a corporate governance event, there isn't qualifications for different size companies. So it's always been kind of an accepted norm that governing a big company is the same as governing a small company. But wherever I go, I always ask people to raise their hand, and I ask them the following question. I say, well, who here thinks that operating Intel is the same thing as operating a $25 million med device company? And predictably, no one other than a lunatic or someone who's not paying attention is going to raise their hand. And I said, well, does anybody think that governing them could possibly be the same thing, right? Governing Apple or governing Chevron is not the same thing as governing a $100 million fabless semiconductor company. It is not the same thing. And so it follows that if operating them can't be the same thing, then governing them can't be the same thing either. And so there are resolutely unique challenges, which really, and when it comes down to it, and from my perception as a former institutional investor, Doug, the one-size-fits-all approach to corporate governance has been harmful to generations of small-cap institutional investors.
Yeah, absolutely. I think that applies to a lot of things, including executive comp, all of this stuff we see in the market today. But what you were saying before about trading volume and these types of things being these are fundamental issues that the people in the boardroom and worrying about corporate governance, they have to worry about, unlike the mega caps and the large caps. You chose to devote quite a bit of your book, more than half of it, to corporate finance and capital markets. I wasn't expecting that. And I don't think most people looking at a corporate governance book would dive in expecting to see that. And so talk a little bit about how, why you decided to structure the book this way.
So again, especially from the perspective of buy-side person, math and data rule everything, right? So when you look at the public company landscape, 80% of the companies, public companies, market caps below 500 million. Well, what do you know about those companies? An enormous percentage of those companies are not cash flow positive. So whether it's the entire life science ecosystem or whether it's technology companies, resource companies, also, these are companies that serially, not one time, serially access the equity capital markets. So to give you an idea of how big that marketplace is, in any given year, small cap companies raise somewhere between 25, so these are, again, existing public companies, these are not IPOs, somewhere between 25 to $50 billion a year. Okay, and in sight, that sounds like a big number. In some years, for example, in 2016 and 2017, that marketplace was larger than the IPO marketplace. You never hear about that funding ecosystem. It's never in the Wall Street Journal. It's never on Bloomberg. No one ever talks about it on CNBC. It's the quietest 25 to 40 or $50 billion financing ecosystem on earth. Reason people differ is about why that is. But when you look at the fact that these companies, if you don't have cash and you need to go raise money in the equity capital markets, there is no bigger enterprise risk for your company if you're going to run out of money and you need capital, because no capital, lights shut down, parking lot closes, that's the end. And so from my perspective, of a fund manager that was in the business of providing that growth capital, I can tell you, I'm not speculating at all, that we wildly out-negotiated most small cap companies. And our limited partners benefited dramatically from that. And so what is the takeaway if you're on the other side of the table? The other side of the table is, well, one, we know we're going to have to access capital. And we have this person over here who invested hundreds and hundreds of millions of dollars telling us that you guys actually aren't so good at this, right? Because the buy-side people are benefiting dramatically from that. So again, first, from a number standpoint, enormous ecosystem. Number two, inartful financings create wildly unnecessary dilution for all parts of the small cap shareholder ecosystem. And it's a subject matter that no one has ever spoken about publicly. I mentioned earlier the educative gulf. In fairness to CEOs, CFOs, board members, if you're on the board of a $100 million life science company, you need $25 million. Where are you going to go to get a checklist of, hey, make sure you don't do the following things? In fairness to them, that checklist never existed. Right?
Yeah, in the book you talk about kind of the difference between a good stock and a bad stock, and how you need to be a good stock, and how good companies can end up being a bad stock. And I'm sure, that's kind of the larger companies, they don't really have to deal with that kind of stuff.
No, and look, it's actually really surprising to people who are predominantly from the large cap ecosystem that there are small cap companies that are just mired in illiquidity. They literally toil in obscurity. And I'm not talking, by the way, I'm talking on, there are NASDAQ and NYSE companies that something like 30% of companies, small cap companies, have no research coverage. I'm not talking about they only have one or two analysts, zero, right? So these companies are toiling a lot of times in obscurity, and that's a big difference. The other phenomenon that you see all the time, and I talked about this when I gave some testimony at the SEC a month ago, was that it's also a very, very odd idea to people in the large cap ecosystem that you can find small cap companies that are, to the outside person, look fundamentally identical. Very similar businesses, very similar revenue, very similar profitability, yet one company is literally valued at 2x the other one. The trading volume is 3x the other one. One of them has loads of analysts, and the other one is just kind of down for the count. And you think, how can that be? Happens all the time in the small cap ecosystem, right? And there's a lot of reasons for that, but that you don't find that in the mid and large and mega cap ecosystems. virtually at all. Right?
And so, one of my takeaways from reading this and seeing how much of the book is dedicated to these financing type issues is, if you're a director and you get invited to be on a smaller cap company or nano or micro cap, read the book first before accepting the position, because you need to know, all right, this is the job I'm getting into. It's not the same as that, mid-cap company, the, Russell 3000 company that I'm on. It's a much different ball game, and unless I'm ready for that, should not accept that board seat.
You're not going to hear me disagree with you on that one.
Let's talk about shareholder activism, which
Sure.
To a lot of our audience is the hottest topic. It's been for the last couple of years. Small cap companies are much more vulnerable targets for activists, even though we tend to talk a lot about P&G and DuPont. That's not the normal. That's not the normal proxy fight. And so, but given that governing a small cap company is so much different than the large cap, is defending against an activist attack different for small cap companies as well? And how, what's a board need to know about that?
It's a completely different world, just like a lot of the things we're talking about. First of all, you mentioned that there's this disconnect between everyone, the media coverage, right? If all you did was look at major media, you would think that there's only 4 or 5 shareholder activists, right? There's Nelson Peltz, Carl Icahn, et cetera. But in reality, and there was an interesting webinar recently, Keith Gottfried, the iconic shareholder activism small cap defense lawyer at Morgan Lewis, put on a webinar where he said he reckons that something like 80% of shareholder activist campaigns are actually in small cap companies, right? So the exact opposite of what you would think if all you did was look at major media. And there's a couple of reasons for that. Number one, math. We've talked about math a few times already. Math is definitely one of the reasons. You can be a much smaller fund on the buy side. It's much cheaper to buy 5% of a $200 million company than 5% of a $200 billion company, right? Yeah. So it's just math on the one hand, right? Yeah. The entry price is lower. But also the sophistication level or the experiential level of those boards is usually going to be different than of much larger companies. And so there's a vulnerability there to it. But the problems that when you go to a corporate governance event, and you and I probably sat through a lot of the same settings, and hearkening back to what we said earlier about the fact that so many of these are large cap focused, the first thing as part of the shareholder activism conversation and any kind of panel discussion people talk about is, well, you have to assemble your fight team, right? You got to get the special lawyer, you got to get the proxy folks, you got to have the solicitors, then you have to have the PR firm and all these things. Well, those are facts that are resolutely not in evidence for most public companies in the United States, full stop, right? And I know it's always surprising when people in the large cap ecosystem, everyone kind of leans forward like, what is this guy talking about again? They don't have the resources. Yeah. Right? They don't have the resources to go out and hire all these folks. Rich people's problems. So on the first, that's right off the bat is a really material difference. And the other thing I mentioned is that and this, in fairness to the shareholder activists, it drives shareholder activists crazy, and I know a number of them, is that a byproduct, if you will, of operating or toiling in obscurity as a public company is you begin to believe that no one's really paying attention. So oftentimes, when an activist investor shows up at a diminutive public company, knocks on the door and says, I want to talk to you, I own 4% of your company, I'm not happy with X, Y, and Z, the reaction from a lot of, unfortunately, from micro and small cap folks and nano cap people is like, we don't really need to talk to you, and ignore them. Yeah, and they think intuitively that, hey, you know what, this is our company, right? I mean, with all due respect, just stay over there. We're good. And they have a fundamental lack of understanding of the fact that, A, activist investors rarely show up for no reason. Number two, they're not going away, right? And if you ignore them, all it's going to do is inflame the situation. But if you are a capital markets neophyte and you've been operating a company that's been toiling in obscurity for years, in fairness to them, it's not surprising that that's a lot of their response. So you see not a lot of resources to deal with it, not a lot of capital markets experience, oftentimes a CEO in the C-suite, but also oftentimes it's not just limited to the C-suite. You also have a lot of board members of micro, nano, small cap companies. They're also governing a public company for the first time. So they're not necessarily conversant in the capital market ecosystem as well, certainly to sit across the table from institutional investors and interact with them.
And so let's talk a little bit about, that's a good segue into our next set of questions on, board composition.
Sure.
Another hot topic these days, board recruiting. So obviously small cap companies, they, in terms of how they construct their boards, who they put on, what type of skill sets they're looking for. Talk a little bit about that and how
Sure.
it probably differs from what we're used to talking about.
So here's a place, and people assume that because I was an institutional investor and because I'm involved in governance, that I think that shareholder activism is terrific. And I don't really believe that personally. Like a lot of things in life, I think there are some small percentage of shareholder activists that do a terrific job, and then there's a lot of other. But one thing I think they do terrifically well, certainly the ones that I'm conversant with, is I think that talking about board composition, sometimes you almost need like a glossary just to understand what people are talking about. And it's gotten, sometimes it's so convoluted the way people describe it that you can think you're in the wrong room. It's hard to understand what people are even talking about. The shareholder activists I know speak really poignantly and succinctly about board composition. And what I hear them say is, look, every company has a handful of strategic imperatives. Every company has a handful of offsetting impediments. So that's bucket number one, strategic imperatives. Bucket two is an offsetting list of impediments to achieving those strategic imperatives. That's bucket number two. Bucket number three is every company has a list of or key stakeholders or customers. And if you put those down one side of a whiteboard, and on the other side of the whiteboard, you basically put down all of the backgrounds of all the board members, you simply see whether the backgrounds map to those three buckets. And it's a very, it's an easy way not only for people to understand, but also to actually articulate and practically to actually undertake. And when most public companies, and this gets back to one of the reasons why I wrote the book, when most public companies, again, which are small cap companies, when most of them do that, again, most of them are out there raising capital. What you will find is that a key strategic imperative and impediment is capital raising. Because there's only one thing that solves cash problems. It's cash. Interestingly, what I found as an institutional investor and also now as someone who advises them, that is a glaring hole when you go to map the backgrounds of board members to the strategic imperatives and impediments, etc., that it's really instructive how many small public companies fail that board composition test. In other words, put it in the opposite. How many of them are serially raising capital without any board members? Let's just be frank about what I'm saying. Without any board members with capital markets or corporate finance expertise. And the people who win that, buy-side guys, day after day after day. There is no way you can fake understanding capital markets or corporate finance. You either do or you don't. And so just like if you were a life science company and you were trying to usher an oncology molecule through the clinic, on your board you would certainly have MD, PhD, Mary or John in order to help you devise the process, etc. Well, if you're going to be out there accessing the equity capital markets over and over and over again because you have to, and you have no one in the boardroom that understands that, that's a glaring board composition problem. And I speak about it, I say everywhere I go, that if you're going to access the equity capital markets, you need to put someone on your board that understands that. And it's not getting, I'd like to say it's getting a lot better, Doug. It's not getting a lot better. And I'm not sure the answer of that, by the way, but it's not getting a lot better.
And so I guess, part of the challenge here is that, a Johnson & Johnson, whoever they ask to be on their board, they're going to say yes, right? And they pretty much have their pick of the litter other than the people who are conflicted. Smaller nano cap companies, not so much, right? They can't pay as much. They're riskier. They don't have the name,
Sure.
This like reputational enhancement for somebody's resume. So, at that point, what's a company to do?
I've kind of come full circle on this issue, and I have a different view, frankly, than when I wrote the book. When I wrote the book, I came across an interesting statistic that there are Fortune 100, and this underscores the point, there are Fortune 100 companies that spend more on one director than a lot of small cap companies spent on their entire governance ecosystem. Right? And that kind of underscores the issue. But I've actually come full circle on the issue in the following way. When you look at, for example, National Association of Corporate Directors, when you look at boardprospects.com, when you combine them, and there's some overlap there, but let's just say conservatively, there are 30,000 people in those databases. Now, I'm not going to qualify as every one of those people as being hyper qualified to be on a board. That would be unfair to say so. I don't know those people individually, but that's a lot of people looking for board seats, right? And there's an awful lot of, for example, incredibly qualified former retired military officers that are looking for board seats unsuccessfully. I believe that the we can't pay enough and we can't find qualified board members is every bit the canard, if you will, as companies saying, gee, we find it, the reason why we have no females on our board is we can't find any ones that are terrific. Well, that's a lie, right? That's a lie, right? Let's just be frank about it, right? Yeah. So when I look at a lot of these small cap companies, they say, gee, we can't find anybody who want to be on a board. And you're right, the board stipends, by the way, sometimes, well, at the really small end of the continuum, there's no cash stipend at all, right? We're going to give you stock options in a completely illiquid stock, and let's hope it all goes north. So yes, no one is joining the board of a micro cap or a small cap or nano cap company thinking they're going to get rich. They're doing it because they're really passionate about that ecosystem. But I guess to bookend my thought on this, Doug, is that there are an awful lot of over-the-top qualified people looking for board seats. So if you really want to find them, they're out there. And I think my position has changed on that. I was a little in the former camp, but I've seen and spoke to so many of them over the years that I think they're out there if you really want to find them.
Yeah, you just got to do some work.
Yeah, I think that's right.
Let's touch upon one thing that actually is kind of personal to you. You have you spent some time working with and advising former military people on board searches and how to be a director, which I've not come across before, but I do know several really good directors who are have military careers. Talk a little bit about that.
Yeah, so that comes from some of the work I've done with National Association of Corporate Directors. I write the Entrepreneurial Governance column, by the way, of that name since 2012. Created that really with Judy Warner. It's the only small cap corporate governance column that I'm aware of, by the way, definitely in the United States and maybe elsewhere. But there's a Henry Stever, who's in charge of marketing at NECD, created a terrific program. I think I'm right in attributing it to him. Called Battlefield to the Boardroom, because he's a Marine, and asked me a number of years ago, would you be interested in helping out? And I thought, wow, it'd be an honor to do that, and it has been. But it's interesting. It is somewhat anathema to a lot of certainly flag officers to talk about themselves, to self-promote, to be able to say, hey, I'm the right person for this. It's really challenging. It's not in their, to use an oft-used term, it's not really in their DNA. It's not in their makeup. And if you're not comfortable doing that, you shouldn't do that. But that creates a bulwark towards getting a lot of these hyper-qualified people on boards of public companies, because they just don't have a lot of what's required to sit in front of a CEO and say, hey, let me tell you about some of the things I did. And I attribute that, and I've been fairly outspoken about it. I think the government does a poor job of explaining to the private sector what people actually do in the military. I mean, for me to listen to some of these folks talk about what they've done, I mean, to say it's over the top impressive is the understatement of the year. I can't believe sometimes what people are responsible for in the military, and of course execute with aplomb. And then afterwards they say, so do you think that would be helpful to a small public company? And I think, wow, transformative, yeah. Right? But because they don't have that in them to kind of promote themselves or even talk about themselves, it really is an impediment. So there's this kind of yawning disconnect between the unbelievable need for people like that and over here the resistance or reluctance to kind of self-promote. And so sure. Yeah, it's been a terrific experience.
I'm sure it's been incredibly rewarding. Back to what we were talking about before with the financing and dealing with the capital markets. What you were talking about in terms of directors really need that skill set. Boards need to have that skill set. Almost implies that these directors are actually going to be involved in that, and a lot of the kind of corporate governance purists would say, no, you boards should not be involved in that. That's investor relations.
Sure.
And now, we have a movement saying boards should be involved in shareholder engagement, but that's largely on the governance side they're talking about. But I think what you're implying is that these directors really do need to be involved in the IR efforts. So
yeah, I would bifurcate that a little bit. So I said earlier that there was a woman that I had this conversation with who was telling me that trading volume was not a governance issue. I've had the same conversation with other large cap focused people saying, Adam, all of these things that you're talking about, the board's role in all of these financings, this is management. I don't think you understand the kind of the nose in, fingers out. I don't think you understand the difference between management and governance. And I replied back to them, well, let me give you an example. And this is, by the way, very common in the small cap ecosystem, where you have a CEO and CFO who might never have shepherded a public company before. And people say, well, what's a great example of a difference? Well, it's a really big difference when you have a CEO or CFO that's never shepherded a public company.
Now, never even worked for a public company.
Exactly. Now, I always need to be careful in talking about this because people might go to a place and think, geez, you're not impugning those people's intelligence or their work ethic. Of course not. You can be the smartest person on earth, work really hard, but it's really challenging and professionally to make up for experience you don't have. So if you've never shepherded a public company and your company requires capital, again, not elective surgery, you're going to run out of money in 3 quarters and you need capital. Now, that's about the biggest enterprise risk that board faces. So as a board member, are you going to now, if Jamie Dimon was a CEO, the board probably wouldn't even have a meeting about it. Right? Jamie Dimon is going to figure out a way to access the capital markets. He knows exactly how to interface with institutional investors, does it literally every day. But if you're on the board of a company with Bill Dimon as the CEO, who's never run a public company before, deference is replaced by heightened skepticism because you're relying on someone who might be really smart, really experienced in their own right, but has never done what they're about to do. And again, it's not elective surgery, right? You don't get the cash in the door, the lights go out. And I'm not talking about a tiny cross-section of companies. I'm talking about the majority of public companies in the United States. So all of these folks that I got lectured to about hey, Adam, that's a management issue. Well, it's maybe a management issue for a company that isn't going to run out of money in 2 quarters and is run by somebody who has done it a dozen times. But that board better have both hands on the wheel. And I'm not suggesting, though, in that, and I'm always careful, and I think other people that bring it up are 100% correct. I'm not nose in, fingers out applies to every company. Doesn't matter whether it's a tiny company or a big company. I'm not suggesting that in a situation like that board members are somehow going out and raising the capital. That is the job that is an operational issue. But boy, do people need to get right up against that line when you are dealing with an enterprise risk that is a capital E, capital R. We're going to run out of money in 3 quarters, and the CEO and CFO have never done this, or they did it once and it didn't go very well. As a board, it would be reckless to do the opposite, right? To sit back and say, I think they got it. I mean, I'm good. We're over here if you need us, right?
And so are the directors actually going out on the road shows? I mean,
no.
Where does the line, stop?
Yeah, well, first of all, again, I mean, I think that nose in, fingers out applies. But I'll give you another example. So people, I've used this example with people where I've said, I ask boards all the time, hey, have you ever been to an investor conference to watch your CEO and CFO present the company? And oftentimes I get the answer, well, no, why would I do that? In fact, I've never heard that at a corporate governance event as a good exercise. Well, again, you have Mary or Johnny who have never run a public company before. You have no idea actually how they're interfacing with investors. And by the way, what their communicative skills are, what their extemporaneous speaking skills are, how they deal with investor Q&A. If I'm a board member, I better actually witness that with my own eyes. Because again, none of this is elective surgery if you're about to run out of capital. So I think, number one, certainly witnessing that in an investor conference setting. There are times, and this is increasing a lot more now, Doug, than years ago, where institutional investors that do what I used to do will say to a company, sure, we'll give you $20 million to help you get your molecule through the FDA clinic, But if we do that, not only are we going to do a site visit, not only do we want to talk to your clinical partner, but we actually want to talk to your board member. And there is not a lot of, whereas in a large cap environment, maybe a director can say, either I'm not the right person, or you're going to have to talk to our corporate secretary or somebody else, I'm not going to do that. If you need capital and someone's saying, we're going to give you the capital, but you have to actually talk to us, you're going to talk to them, right? You have no choice. So it's a leverage issue more than anything else. But look, it is a fundamentally different situation in having companies shepherded by those who are relatively new. Deference is going to land you in a bad place as a board member when you have a CEO. I mean, could they end up being right about everything they're saying? Sure, but or you better confirm to the best of your and your board colleagues' abilities that they are.
Yeah, you better go watch the games.
Better go watch the games.
So, but in terms of, so that's interacting, kind of from the financing aspect. What about interaction with management? Still, the same noses in, fingers out type principle, but there's got to be a little bit more hands-on, beyond just coaching for a board member at a smaller cap company, where I imagine at times it's all hands on deck.
Yeah, I mean, look, again, I think the fundamental difference is you are dealing sometimes, and I want to be careful here, I'm not suggesting that every CEO or a CFO of a small cap company has never been. There's some terrific, highly experienced CEOs and CFOs in the small cap ecosystem, to be sure. But when you are experiencing a situation where there is a CEO and CFO that doesn't have that much experience, again, deference doesn't work. Or deference is going to chronically underperform if you continue to be overly deferential to someone who's never done that job before. So it is incumbent upon board members to make sure, and that's something where, as we mentioned when we were talking about doing this program, about kind of what large cap companies can learn from small cap companies, that's one of those things. Small cap board members necessarily have to be less deferential because they might be dealing with someone who doesn't have a lot of experience. I'd recommend that large cap board members can learn a lot from ratcheting down the deference a little bit. By the way, even if it is Mary or Johnny, famous CEO, right?
Absolutely. I mean, it's interesting to see like the corporate governance failures. At the large companies where directors really were too deferential, they were not asking for the information. But really, the same thing happened at Theranos, where you have really, really smart people on the board that did not ask many questions and just trusted this kind of, charismatic CEO type, and the thing, the whole thing was a house of cards. So,
but smart people, I'd take the other side of that. Unbelievably smart people, but if you get back to our somewhat simplified Byzantine way of mapping board composition, you would have found an enormous glaring hole, right? People have joked about the fact that board was more well suited to go to war, right, with George Shultz and Henry Kissinger and other senators, et cetera, than it was to preside over a phlebotomy machine, which is really what we're talking about. And when you look at that, when you say smart people, how many people on that board have had experience bringing a medical device to market?
Yeah, I mean, it was probably a mega cap qualified board being asked to oversee a startup. We have a question for the audience. How many open board seats are there on average at any time?
Wow, it's a terrific question. I don't really know the answer, but let's just do the math. I mean, obviously there's, almost 15,000 public companies, and now, in fairness, a lot of them don't turn over, and in the smaller company ecosystem, it's not surprising to see people on the board for 20 years, right? Because nobody's watching. There's no, and that's another thing that often gets lost. Large companies are so focused on the governance ecosystem, and the conference is so focused on proxy advisors. If this whole table is all the public companies in the United States, this one piece of paper represents the public companies that proxy advisors actually cover, and that's not a bad rendering. Right? So the overwhelming majority of public companies aren't even covered by proxy advisors, right? But I think that on any given day, most of those boards probably don't have a lot of openings. Again, towards the smaller end of the continuum, just because nobody's looking, nobody kind of encourages them to turn over boards. So I wouldn't really hazard a guess. I'll covenant to try and find that out and do some better math and see if I can come back with an estimate.
Yeah, I mean, we talked about what you said, like about 30,000 board seats out there, and say, there's a turnover of 10% a year, something like that. But to your point, there are a lot of open board seats, and there are probably more qualified people for those seats than people realize.
Right, and if you do the math, you could say, as far as the number of actual board seats, if you just use really simple math and say there's 15,000 public companies, right, and there's five board seats, you can kind of back into how many there are. How many come up on any given basis is something I will definitely look into. Good question.
So, I guess we've talked a little bit about our kind of, incorporated some of the lessons that large cap directors can learn from small cap. Anything else that you think, would be important to cover in that area?
Yeah, it's such an interesting question, because a lot of my experience is a lot of large cap folks don't really think they can learn anything from small cap companies, and so I always like to kind of prod those folks to think more. But here's one thing that's really interesting where I think that resources, it's always assumed that having lots of governance resources is going to inextricably translate into better governance, and that is true sometimes, as we know, and sometimes it's not true at all. One of the areas where large cap board members can get inoculated a little bit or kind of insulated, pardon me, from reality is in setting agendas, right? And you of course know, from being a corporate secretary at a large company, there's a governance staff, there's lots of board members. You can imagine that there are, and without naming names of any of the board members that you assisted, there are some board members that from time to time, maybe they're really busy in their lives, they're doing different things, they're on other boards, they're running a company. You have the luxury sometimes in bigger companies to think, hey, you know what? I don't necessarily have to have both my hands firmly on the wheel with respect to setting the agenda for this quarter. One, it's maybe somewhat rote or formulaic. Anyway, we have the same things that we do. And mind you, we have a governance staff of incredibly smart people, as well as all these board members. And I'm a little busy, so I can kind of coast this quarter. And it's resources and people that give the opportunity to do that. But when you think of, resources and people are things that most public companies don't have, right? So if you're on the board of a company and of course, number one, most public companies don't have a standalone corporate secretary. It's a role that gets subsumed by the CFO. So it's not even a standalone corporate secretary. There's no governance staff in most public companies. And you're also dealing with much more diminutive board. You're dealing with 4 or 5 independent board members. And so what do you know about key risks that don't make it on the board agenda? That's bad, always, 100% of the time. And so if you're on the board of a company that doesn't have a governance staff, that has no corporate secretary, a standalone corporate secretary, by the way, probably not an in-house counsel either, and there's only 4 other independent board members, the only way that agenda is getting artfully, accurately, proactively set is if every person in advance of the board meeting is focused 100% on, hey, what are the key enterprise risks that literally can kill this company in the next 2 or 3 quarters? We better make sure that we're focused 100% on, is our strategy right for right now? What are our competitors doing? And what are the risks that can kill this company? And if those things are not on the agenda, and I don't make sure as a board member that is definitely on the agenda, that movie almost always ends badly. And so I think that that's something where large cap folks can learn from, that there is no such thing as kind of coasting for a quarter or 2 when it comes. I mean, nothing is more important than what's on the agenda for the board to be focused on in real time. That's the one time when you have everyone together, right? And inartfully setting those or not having everybody's input is incredibly important. I mean, the flip side is also true, which is very, very rarely are there great discussions about things that aren't on the agenda.
That's a whole nother subject. Maybe not for a webcast, for a conversation at the bar.
Right.
A couple of things that you just said that probably frightened a number of people listening to this webcast. One, you said most companies probably don't have in-house counsel.
Yeah.
And you said most companies don't have a standalone corporate secretary. That job is usually subsumed by the CFO.
Yeah.
Talk a little bit about that, because I think a lot of people would be like, "What the? Are you
Yeah.
What just came out of his mouth?
Yeah,
When you rewind and see, did he really say that?
Yeah, no, I really said it, and I intended to. I didn't misspeak. Yeah, I mean, at the majority of public companies in the United States, the corporate secretary role is subsumed by the CFO. And why does it go to that person? I'm not sure about the reason, the original reason for that, but at most public companies, I can sure as day follows night, the corporate secretary is the CFO. There isn't a standalone. Why? Again, well, it's a resource issue, right? I mean,
who else is going to take that job, especially if there's no in-house counsel?
Right.
Where else is going to, head of HR is not going to do that job.
Right.
Yeah.
So that's where it ends up. It ends up under the finance function, and it's just axiomatic. It's just the way it is. The in-house counsel is a really interesting, certainly for two people who were started out their careers as lawyers, and I was an in-house counsel as well for a short period of time. And this has changed it's become even more austere, I would argue, since the financial crisis. Since the financial crisis in most public companies, again, we're not talking about the minority, we're talking about the majority, the in-house role has kind of been recast as more of a luxury, kind of a nice to have versus a must have. The belt tightening that went on after the financial crisis never stopped in a lot of small cap companies. And so, again, we're talking about companies that are serially accessing the equity capital markets. There's not a lot of money floating around. And so for companies that didn't have in-house counsel, they definitely were not going to be adding them after because of resource issues. But it's amazing how many companies, even before the financial crisis, I mean, I would say anecdotally, and I've never done an actual assessment of this, but considering that we met with well more than 1,000 public companies when I was an institutional investor, I mean, the number is way more than 50% of the companies we met with, and I wouldn't be surprised if it was more like 7 out of 10. And in fairness, those companies, again, just to harken back to the original question you asked, those are in companies with $500 million market cap and below. Once you start getting above that, I would argue once you start getting above $300, $400 million, where the institutional, it flips between the amount of institutional percentage of institutional shareholders versus retail shareholders, those companies start adding in-house counsel quite a bit. And by the time you get above 500 million, it's obviously much more common. But again, talking about 80% of the public companies in the United States, right, that are below 500 million. And it is absolutely commonplace for those companies not to have any in-house counsel today still.
Got it.
Yeah, which is, it is amazing for people in large cap. Everybody kind of leans forward and says,
yeah,
that guy just said that, right?
Yeah. Let's see, before we wrap up here, let's get your kind of observation or you're thinking about dual class shares, something that's very front and center,
sure,
especially amongst the governance types and the institutional investor types who are watching.
Sure. So look, I because I spent a lot of time in Silicon Valley, a lot of time with founders, as well as also on the public company side, I understand why, if you're a founder, you want to have dual class stock. You have, on the one hand, characteristically kind of imperious VCs who historically have kind of done whatever they've wanted with their portfolio companies on the one hand. On the other hand, you also want to make sure that your vision for the company, however idiosyncratic it might be, that you have the opportunity to be able to carry that out, and none of the conflicts of interest of, hey, the Series A person wants to hit the door now and the Series C person doesn't, all those things, you kind of take that out of the equation. So I differ, I guess, from perhaps some of the governance purists in that I get 100% why they do it. The question becomes, and again, to some extent, as a public company person, I've always said, hey, look, if you don't like the governance, then don't buy the stock. That's not quite true, because there's a lot of passive investors that have to own the stock. And so you and I end up owning stock through an index fund in companies where you can't possibly get rid of the CEO, and does that trouble people? Well, I'll leave it to all the various academics to kind of plot and argue about the success quotient of those control companies versus not. I'll tell you where I think things are probably heading. From my perspective, I think that sunset provisions are likely to kind of rule the roost over a period of time, where when companies come public, they're going to make a bargain. The market is not always going to be so ebullient or awash in late stage capital. If interest rate starts going up, late stage capital is going to pivot downwards. And so this ecosystem that we're in right now is not going to last forever. And when the bargaining chips begin to fall back further into the capital markets, people are going to say, sorry, that actually isn't going to fly. So in order to get public, you're going to need to tell us that we'll give you 10 years to execute your vision, and we get that and we understand the merits of it. But after that, and certainly the, you're going to sell us common stock and we don't get to vote, I don't see that happening a lot going forward either.
So we'll give you a 10-year term dictatorship.
Yeah, I think that's right. And look, fundamentally, that's really what's going on, right?
Sure,
that's really what's going on. And you're betting on that person. You're betting on the jockey, not the horse, 100%.
Yep.
But everybody, the filings say that, everything says that. Look, you're betting on the jockey, not the horse. And look, everything couldn't be more clear with Facebook that you're betting on Mark Zuckerberg, right?
Yeah.
You can't get rid of the guy. So for better or worse, he's there. He's not going anywhere.
And he's not old.
No, he's not old. That's right.
So Adam, we've come to our hour, and really want to thank you for being so generous with your time and knowledge. So thank you for being here.
Sure, thank you.
Just want to go over a couple things before we wrap up today. We've got a couple great programs coming up. Our Governance Watch webcast continues on July 10th. We also have an in-person meeting for our members about the job of the corporate director, perspective of auditors, regulators, and accounting organizations in Washington, D.C. on September 6th. And then in October, on the 23rd, we have our annual members meeting, which is actually celebrating the 25th year of the Governance Center. I want to thank Adam again, and this is once again his book, The Perfect Corporate Board. And for those of you who are seeking CPE credits, be sure you've entered your full name and email address and specified CPE in the space provided at the bottom of your screen. Thanks, and see you next time.